President Trump has just raised tariffs on Chinese goods from 104% to 125%, sending global markets into a tailspin. This unprecedented move has shocked even Chinese officials, who were already preparing for a trade confrontation but didn't anticipate this magnitude of economic warfare. In this analysis, we examine the immediate consequences of this decision that's reshaping the global economic landscape. With China supplying the majority of America's imported goods, from smartphones to computers, American consumers are about to feel the impact directly in their wallets. The question remains, is this a strategic masterstroke or an economic miscalculation? When former President Trump announced his decision to increase tariffs on Chinese goods from 104% to a staggering 125%, it signaled a dramatic intensification of economic hostilities unlike anything seen in modern trade history. This move, representing the most aggressive tariff policy since the Smoot-Hawley era of the 1930s, was characteristic of Trump's distinctive approach to international commerce. His America First policy framework consistently emphasized what he termed reciprocal trade, the principle that the United States should impose tariffs matching those levied by trading partners. In justifying these unprecedented tariff levels, Trump repeatedly cited the trade deficit with China, which reached $382 billion in 2023 alone. "We've been taken advantage of for decades," Trump stated during a rally in Pennsylvania, and now China will finally pay the price for their unfair practices. His administration specifically targeted strategic sectors that form the backbone of China's export economy, including electronics, telecommunications equipment, rare earth minerals, and manufacturing components critical to advanced technology production. Economic experts from across the political spectrum have raised significant concerns about the potential domestic consequences of such dramatic tariff increases. The Peterson Institute for International Economics projects that American households could face additional costs averaging $2,400 annually as a direct result of price increases on imported goods. Similarly, a study from Goldman Sachs suggests the tariffs would potentially reduce U.S. GDP growth by 0.3 percentage points within the first year of implementation. Yet Trump remains undeterred, believing short-term pain will yield long-term strategic advantages. The timing of Trump's tariff announcement appears deliberately calculated to coincide with several domestic and international factors. Coming just months before key Midwestern primary elections, the policy resonates with manufacturing workers. In states like Michigan and Ohio, who have long harbored resentment toward Chinese industrial competition. Internationally, the announcement exploits a period of relative economic vulnerability for China, which continues to struggle with a property sector crisis and declining growth rates that have fallen to their lowest levels in 3 decades. What makes Trump's approach particularly distinctive is his apparent conviction that America possesses greater economic resilience than China to withstand a prolonged trade conflict. "We have all the leverage, all the power, and they know it," Trump claimed during a press conference introducing the tariff increases. This belief stems partly from America's more diversified economy and partially from Trump's assessment that China's export-dependent model makes it disproportionately vulnerable to access restrictions in its largest market. The specific industries targeted reveal a sophisticated understanding of China's economic vulnerabilities. By focusing heavily on technology exports and components for advanced manufacturing, the tariffs strike at precisely the sectors Beijing has identified as crucial to its Made in China 2025 initiative, the country's strategic plan to become dominant in high-tech industries. The tariffs would affect approximately 58% of Chinese exports to the United States, with particularly severe impacts on consumer electronics, medical devices, and automobile components. A critical question remains whether these tariffs represent a carefully calculated negotiating tactic or simply impulsive economic nationalism. Historical evidence suggests Trump frequently employs extreme opening positions as bargaining leverage. During his previous administration, initial tariff threats against Mexico and Canada subsequently moderated during USMCA negotiations. Similar patterns emerged in trade discussions with the European Union and Japan. This approach aligns with negotiating tactics Trump described in his book, The Art of the Deal, where he advocates starting with maximalist demands before accepting compromise. The fundamental wager underlying Trump's strategy appears to be that China's political leadership will ultimately prioritize economic stability over nationalist pride. By applying maximum economic pressure, Trump seems to believe America can force concessions on long-standing issues, including intellectual property theft, forced technology transfers, and market access restrictions, that previous administrations failed to resolve through traditional diplomatic channels. Beijing's counterstrike against Trump's tariff offensive has revealed a startling contradiction. While China's Commerce Ministry publicly decried the U.S. tariffs as actions that seriously damage the rules-based multilateral trading system and seriously impact the stability of the global economic order, their lightning-fast implementation of retaliatory measures tells a different story. Within mere days of Trump's announcement, China imposed restrictions on 18 American companies, primarily in the defense sector, adding to existing sanctions on approximately 60 U.S. firms. This swift response suggests not improvisation, but rather a well-rehearsed economic contingency plan. This paradox raises a compelling question. How could a nation expressing shock at Trump's tariffs possess such a comprehensive and immediate counter-strategy? The answer lies in years of strategic preparation. China has methodically reduced its export dependency on the United States from approximately 20% in 2018 to just 14% today. Simultaneously, China's trade relationships with global South nations now surpass its commerce with G7 countries, creating a diversified economic foundation that can better absorb American economic pressure. The precision of China's response reflects a leadership that anticipated this confrontation long before Trump's return to office. Chinese policymakers have expressed confidence in their ability to withstand the pressure, suggesting they view this as a long-term economic struggle rather than a temporary trade dispute. During Trump's first administration, Beijing employed tactics such as delaying license applications and conducting sudden office raids to frustrate American financial and professional services firms. However, their current strategy reveals greater sophistication, balancing punitive measures against U.S. interests while avoiding tactics that might deter foreign investment critical to China's economic recovery. Xi Jinping's diplomatic outreach demonstrates China's determination to isolate the United States in this conflict. In a significant move, he urged the European Union to collaborate with Beijing in resisting what he termed unilateral bullying by the United States. This appeal for a joint effort to safeguard legitimate rights and interests and uphold international fairness and justice represents a calculated attempt to fracture traditional Western alliances and build an anti-U.S. trade coalition. The personal stakes for Xi Jinping cannot be overstated. As a leader who views himself as pivotal in the resurgence of Chinese civilization, capitulation to Trump would be politically catastrophic. Any perception of weakness before the United States would undermine China's projection of power, particularly within Asia where maintaining face is paramount. Chinese leadership acknowledges their asymmetrical vulnerability in an escalating trade conflict, yet remains determined not to be publicly pressured into submission. China's domestic messaging reinforces this resolve. State media portrays the United States not as a trade partner with legitimate grievances, but as a declining power attempting to suppress China's rightful ascendance. This narrative frames the conflict not as an economic dispute, but as an existential contest between rising and established powers, a framing that makes compromise increasingly difficult to justify to domestic audiences. The economic battlefield extends beyond direct tariffs. China is actively cultivating deeper relationships with markets across Asia, Europe, and other regions. Recognizing that many countries with smaller markets are also negatively impacted by the tariffs, Beijing is offering these nations alternative trade arrangements that simultaneously reduce China's vulnerability to American pressure and potentially create new economic blocs outside U.S. influence. Beyond the diplomatic maneuvering lies an uncomfortable truth neither superpower wishes to confront. Financial markets are delivering a sobering verdict on the trade conflict, transforming this geopolitical contest from zero-sum into a lose-lose proposition where ordinary citizens and businesses become the unwitting casualties. The S&P 500's dramatic 9.52% surge following Trump's 90-day tariff pause reveals just how vulnerable global markets have become to the whims of trade policy. U.S. stock markets have demonstrated remarkable volatility in response to the tariff announcements. The Nasdaq Composite shot up 12.16%, while the Dow Jones Industrial Average spiked nearly 3,000 points, representing an 8% increase, following news of the 90-day pause on tariffs for many countries. Yet these gains proved fragile, with markets surrendering portions of their advance as investors process the continuing conflict with China. This market instability reflects the profound uncertainty surrounding the economic consequences of prolonged trade hostilities. While financial markets signal clear distress, political leadership on both sides maintains an optimistic public posture. The stark disconnect between market reality and political rhetoric highlights a fundamental misalignment. Investors are pricing in significant economic damage, even as officials in both Washington and Beijing project confidence in their respective positions. This divergence suggests markets may be perceiving risks that political leaders either cannot acknowledge or have chosen to downplay. Small businesses find themselves particularly exposed to the economic crossfire. Those dependent on Chinese supply chains face an existential threat that larger corporations with diversified sourcing can more easily navigate. As Alex Jacques, former special assistant for economic development and industrial strategy to President Biden, warned, if you are a small business, particularly on the import side or the input side, there's going to be pain. Unlike multinational corporations with substantial resources, smaller enterprises often lack the capital and infrastructure to rapidly reconfigure their supply chains or absorb increased costs. Economic forecasts paint a concerning picture for both nations. The U.S. faces the dual challenges of GDP reduction and inflationary pressure. For China, the situation appears even more precarious, with some analysts predicting the trade conflict could cut its growth rate in half, a devastating blow to a nation targeting around 5% growth. Chinese authorities have begun considering countermeasures, including interest rate reductions and special treasury bond issuances, signaling growing concern about economic stability. Third countries are scrambling to protect their interests amidst the conflict. Taiwan, finding itself in a particularly vulnerable position, faces a 10% tariff and is actively seeking to negotiate its reduction to zero. President Lai Ching-te has emphasized that Taiwan was included in the first group for trade negotiations with the United States. The stakes are substantial. The National Development Council warns tariffs could slash Taiwan's GDP growth by between 0.43 and 1.61 percentage points, potentially pushing growth below the previously forecast 3%. The European Union has adopted a clear stance of economic self-defense. EU President Ursula von der Leyen stated the bloc is prepared to deploy its most powerful trade measures if negotiations fail during the 90-day pause. These include potential levies on U.S. digital companies and approved tariffs targeting over 20 billion euros worth of American exports, from soybeans to motorcycles and cosmetics. While demonstrating a preference for diplomatic resolution, the EU has signaled it will not hesitate to protect its economic interests. And I hope you like this video. If you want to know about how Argentina rejects US dollar aid, click on the next video.